Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to share today's episode with you. We're starting off with a fascinating story about investing legend Peter Lynch, who recently shared his insights on the current state of the market. In a conversation with Josh Brown, Lynch emphasized that, despite the many changes in the financial landscape over the years, the fundamentals of investing remain largely unchanged. He still believes that average investors can fare as well as big Wall Street investors if they look for opportunities in the right places. Lynch, who is known for his successful tenure as the manager of the Magellan Fund, shared some of his investment philosophies, including his preference for looking at companies on the low list rather than those on the new high list. He also expressed his admiration for certain companies, such as Facebook, Microsoft, Google, and Amazon, which he considers to be great companies. However, Lynch also acknowledged that the current market backdrop is dramatically different from what it was during his prime. He noted that there have been many declines since the market bottom in 1982, but none of them have remotely recalled the ferocity of the Great Depression. He also pointed out that there are now many guardrails in place to protect investors, such as Social Security, unemployment compensation, and a more vigilant Federal Reserve. It's interesting to note that Lynch, who is often considered one of the most successful investors of all time, has a rather low-tech approach to investing. He reported that he owns 0 AI stocks and prefers to stick with what he knows. This raises an important question. Can investors still succeed in today's fast-paced, technology-driven market without being heavily invested in AI and other trendy sectors? We'll be exploring this topic further in future episodes, but for now, it's clear that Lynch's investment philosophy remains focused on finding value in unexpected places. Whether you're a seasoned investor or just starting out, his insights are definitely worth considering. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of technology and finance. Today, we're exploring the fascinating stories of two industry giants, Oracle and Micron Technology. Let's start with Oracle, a company that has been making headlines lately due to its significant role in providing AI infrastructure. With a $455 billion backlog at the end of the first quarter, Oracle is poised for substantial growth in the coming years. The company's cloud infrastructure revenue surged 54% year-over-year to $3.3 billion in the first quarter of fiscal 2026, and management expects this business to see revenue soar 77% year-over-year to $18 billion in fiscal 2026. But what's driving this growth? Oracle has signed a $300 billion contract with OpenAI for providing computing capacity over the next 5 years. This deal is a testament to Oracle's crucial role as an AI infrastructure provider, and it's likely to have a significant impact on the company's share price. However, it's essential to note that the stock is trading at 41.5 times forward earnings, which may be considered a bit steep by some investors. On the other hand, we have Micron Technology, a leading supplier of memory and storage for building global AI infrastructure. The company's revenue soared 46% year-over-year to $11.3 billion in the fourth quarter of fiscal 2025, with adjusted earnings per share surging 156.8% year-over-year to $3.3. Micron's data center segment has been the key growth catalyst, accounting for 56% of total revenue and a gross margin of 52% in fiscal 2025. One of the most exciting developments for Micron is the strong demand for its high-bandwidth memory (HBM) products, particularly the HBM3E products. The company has already secured pricing agreements for the majority of its HBM3E supply for most of the calendar year 2026, and it's begun sampling the even faster and power-efficient fourth-generation high-bandwidth memory HBM4 products. Now, let's take a step back and look at the bigger picture. Both Oracle and Micron Technology are well positioned to benefit from the growing demand for AI infrastructure. However, as with any investment, there are risks involved. It's crucial for investors to do their due diligence and consider multiple perspectives before making any decisions. In conclusion, the stories of Oracle and Micron Technology serve as a reminder of the rapidly evolving landscape of technology and finance. As we navigate this complex world, it's essential to stay informed and adapt to changing circumstances. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at the tech giants that are shaping our investment landscape. If you've been following the news, you know that Amazon and Alphabet have been making headlines with their innovative approaches to cloud computing, artificial intelligence, and digital advertising. Let's take a closer look at these two industry leaders. Amazon, with its sprawling empire, has its hands in multiple tech-driven markets, including online shopping, cloud computing, and digital advertising. Its Amazon Web Services, or AWS, is the leading cloud computing platform in the world, with annualized revenue of $144 billion and a stellar operating margin of 32.9%. That's impressive, to say the least. On the other hand, Alphabet is a top choice for investors who want greater exposure to the AI boom. With its involvement in AI research at DeepMind, development of its own chips, and presence in infrastructure hardware through Google Cloud, Alphabet has a key platform that serves the AI needs of its customers. Its Gemini large language models are embedded into its user-facing apps, and the company is leveraging AI to improve capabilities for its advertising customers. Now, when it comes to earnings growth relative to valuation, Amazon's earnings per share are projected to increase at a compound annual rate of 18.6% between 2024 and 2027, higher than Alphabet's expected 14.6% yearly pace. However, Alphabet's shares trade at a cheaper multiple of 23.4 compared to Amazon's forward price-to-earnings ratio of 28.2. So, which one is the best investment opportunity? Well, that depends on your individual financial goals and risk tolerance. Both companies have their strengths and weaknesses, and it's essential to do your own research and consider multiple perspectives before making any investment decisions. As we conclude today's show, I want to emphasize the importance of staying informed and up-to-date on market trends and developments. The tech sector is constantly evolving, and it's crucial to be aware of the potential risks and opportunities that come with investing in these innovative companies. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.